To chapter 11. Today we're going to discuss investing basic and evaluating bonds. We are using Focus on Personal Finance by McGraw-Hill. This is book by 2022. This is an active approach by McGraw-Hill. Okay, make sure you understand this. This is owned in terms of copyright. It's by Kapoor, by Hughes and Hart, 7 editions. Quite a long chapter for you. There's about 6 learning objectives. The first one, explain why you should establish an investment program. Number 2, describe how safety, risk, income growth, and liquidity affect your investment program. Number 3 is identify the factors that reduce investment risk. Number 4, understand why investors purchase government bonds. Number 5, recognize why investors purchase corporate bonds. Number 6, evaluate bonds and making investment. Let's start the class, preparing for investment program. Why do we begin investment program now? The sooner you start investing, the more time your investment have to work for you. The specific goal you want to accomplish must be by the driving force behind the investment plan. Some financial planners suggest setting goals in terms of money, while others suggest setting goals by particular things desired. Goal must be specific and measurable. In establishing investment goals, there's 5 questions you're going to ask. How much money do you need to satisfy your investment goal? Number 1. Number 2, how much risk are you willing to assume on your investment program? Okay. Number 3, what possible economic or personal conditions could alter your investment goal? Number 4, considering your economic circumstances, how long your investment can work for you? Are your investment goals reasonable? Number 5, are you willing to make sacrifices to ensure that you meet your investment goals? Performing a financial checkup. First, make sure you pay your bills on time. You have an obligation to pay your credit purchases on time. Work to balance your budget. Many individuals regularly spend more than they make. Okay. Rule of thumb is to limit your monthly payment for all types of consumer credit to 20% of your next after-tax income, and manage your credit card debt and start an emergency fund, an amount of money you can obtain quickly in case of immediate need. There's a reasonable amount to have on your emergency fund is at least 3 months worth of living expenses. You may also want to establish a line of credit. Accumulate the money needed to fund your investment. Suggestion will be, number 1, pay your bill, then pay yourself. Okay. Number 2, take advantage of employer-sponsored retirement program. So employer will match part of your contribute to make your company continue as retired program. Number 3, participate in elective savings program. Number 4, make a special saving effort 1 or 2 months each year. Number 5, take advantage of gift, inheritance, and windfalls. Okay, continue next slide. How the time value of money affects your investment. What is it? Time value of money involves increasing the amount of money that you save or invest because your saving or investment earn interest or dividends or increase in value. The longer your money can work for you and earn interest or dividends or appreciate, the more your investment will be worth. Number 2, safety and risk. Safety is an investment means minimal risk or less. Risk is an investment means a measure of uncertainty about the outcome. Investors sometimes purchase certain investment because they want predictable source of income. Most conservative and safe investment, example, passbook and saving account, CD, also are the most predictable source of income. Safety and risk. Investment range from very safe to very risky. A speculative investment is high-risk investment made in the hope of earning a relatively large profit in a short time. Investors often choose more speculative stock because of greater growth potential. One basic rule sums up the relationship between the factors of safety and risk. Your potential return on any investment should be directly related to the risk that you assume. What are the components of the risk factors? There's about 4 of them. Number 1, inflation risk. It is the rise of general level prices. For example, the price of bread now is $100. McDonald's here at $100. McDonald's is about, when I bought it in 1984, a dollar about $1.95 to dollars. Now it's about $10. So it shows you because of the inflation risk. Number two, interest rate risk is the result of changes in interest rate in the economy. Changes of interest rate, for example, the mortgage rates up and down because of the interest rate changes. Number three, business failure risk is often a result of bad management, unsuccessful product, competition, or a host of other factors that cause the business to be less profitable than originally anticipated or the expense of loss. Number four, market risk may be caused by political or social conditions as well as many other factors. Example, COVID-19 led to huge losses in the market. As because stores are closed, there's not many people can do a marketing. Investment liquidity. Liquidity is the ability to buy or sell investment quickly without substantially affecting the investment value. Investments range from near cash investment to frozen investment in which it's virtually impossible to get your money. Interest-bearing checking and saving account are very liquid, while CD impose penalty for withdrawing money before the maturity date. Factors that reduce investment risk. Number 11.3. For almost 100 years, stocks have returned at an average return of a little less than 10% per year. These returns are not guaranteed. There have been hundreds of and will continue to be some years of negative returns. The long-term average return of the stock market is well ahead of the inflation and return on the bonds, real estate, and saving accounts or CDs. Before purchasing stock, consider how well asset allocation can help you create balanced portfolio and may help reduce risk on your investment program. Asset allocation and diversification. Asset allocation example is the process of spreading your assets among several different types of investment to lessen risk. That is, don't pull all your eggs in one basket. Asset allocation is often expressed in terms of percentage. The percentage that what I want to put in stock and mutual fund. For example, my investment about 30%, I think it's no 40% in stock and 60% in bonds, mutual fund or bonds. No, so 30% in stock, 40% in mutual fund, the remaining in bonds. And how much percentage do you want to put in CDs? Example here. Diversification provide and investing in different investment provides a measure of safety and reduce risk because cost of loss in one type of investment may be offset against from the others. In good example, to be evaluated, a factor they use to use traditional investment alternatives such as corporate stock, corporate bonds, government bonds, mutual funds, and real estate, from safety to liquidity. This is the way of the calculation. Corporate stock FFT is average, risk is average, income average, high growth, liquidity is average, corporate bond is average, average income is high, and low and average. Okay. Asset allocation and diversification. Percentage of your investment that should be invested in each asset class is driven by your age, your investment objectives, how much you can save and invest each year, the value of your current investment, the economic outlook for the economy, and the other factors. Many personal finance websites provide an asset allocation calculator to help you determine the right types of investment for your investment program. Typical investment in securities, safety, income, growth, and speculation. Example here, pyramid. Level 1 is financial securities such as cash, CDs, money market, mutual funds, and government bonds. Level 2, safety of income such as U.S. securities, selected corporate bonds, mutual bonds, income stocks, and conservative mutual funds. Level 3 is growth stock, growth-oriented mutual funds, and rental property. Number 4, speculative stock options, commodities, and areas of investment. This is decide. Remember, this is give you an idea of the level of risk from the low to high. In terms of the time factor, amount of time your investment to work for you is another important factor that managing investment and portfolio. Also, your age. The younger investor tend to invest a large percent of their nest egg in a growth-oriented investment. The older investor tend to be more conservative and invest in government bonds, high-quality corporate bonds, and very safe in corporate stock or mutual fund. Financial experts suggest you subtract your age from 100 and difference is the percent of your asset that should be invested in the growth investment. Your role in the investment process. Number 1, evaluate potential investment. Number 2, invest time required to do research different investment alternatives so that you can make an informed decisions. Number two, monitor the value of your investments. Many investors use a simple chart. Number three, keep accurate records. Number four, other factors consider using a professional financial planner who has had training in securities, insurance, taxes, real estate, as well as planning. Safeguard against a crisis. Number one, establish a large emergency fund. Number two, know what you owe. Number three, you reduce your spending. Number four, notify credit cards company and lenders if you are unable to make any payments. Number five, monitor the value of your investment in retirement accounts. Number six, consider converting investments to cash to preserve the value. Government bonds and debt securities. Objective number four. What is government bond? Government bond is a written pledge of a government or municipality to repay a fixed sum of money along with interest. U.S. as government securities are backed by the full faith and credit and U.S. government and have always carried a decreased risk of default. Can be held until maturity or sold before maturity. There are four principal securities issued by the U.S. Treasury with a minimum purchase of $100, such as Treasury bills, Treasury note, Treasury bond, and Treasury inflation protected security. We call it TIPS. This is an example of the table in terms of the type of securities. The type of Treasury bill, the maturity range from 4 to 52 weeks. It is discounted and is all maturity government pays the face value of T-bills. Okay, the difference between the purchase price and the face value is interest. Treasury notes range from 2 to 10 years. Interest is paid every 6 months until maturities. Interest is slightly higher than that of T-bills because of the longer maturities. Treasury bonds 20 to 30 years. Interest is paid every 6 months until maturity. Interest rate is slightly higher than that of the T-bills and T-notes because of the longer maturity. TIPS from 5, 10 to 30 years. And interest is paid every 6 months until maturity with a fixed rate applied to adjusted principal. Remember, Treasury Direct conducts auction to sell Treasury securities. Buyer will be interested in purchasing this security as such auction may be bid competitively or non-competitively. Treasury security may also be purchased through banks, brokers with the charged commissions. What is municipal bond? Is a debt security issued by state or local government used to finance ongoing activities of state and local government in major projects, for example, airports, schools, all roads, and toll bridges. May be purchased directly from a government entity that issued them or through account executive. State and local security are classified as the following. General obligation of bond, which is backed by the full faith, credit, and taxing power of the issuing government. Number two, revenue bond is repaid from income generated by the project that is destined to finance. State and local government securities. Interest on municipal bond may be exempt from federal taxes. Municipal bond exempt from federal taxation and exempt from state and local tax only in the state where they are issued. While interest may be exempt, such as capital, that result when you sell the municipal bond before maturity and a profit may be taxable. Due to taxation status, interest rate on municipal bond are lower than those of taxable bond. Excuse me. Calculate the taxable yield. Taxable yield equal to taxable yield divided by 1 minus your tax rate. Excuse me. Example. Taxable equivalent yield. Example here. Taxable equivalent yield is 3%. Taxable municipal bond is 4% is 30%. The tax rate is 4.41%. 3% you cap from here. 1% is here. 0.32 is coming here. The tax bracket will be here. That's how you calculate. Hey guys. This is called the taxable equivalent yield. They'll give you an example in the following slide. Number 5. Conserve investment option. Corporate bond. It's a corporation return pledge to repay a specific amount of money. The interest. The face value is the dollar amount of the bond we receive at the bond maturity, usually 1,000, between time of purchase and maturity date. The corporations pay interest to the bondholders. Maturity date is a corporate bond is the date on which the corporation is to repay borrowed money. between 1 to 30 years after the date of issue. Bond indentures is a legal document that details all the conditions relating to the bond issue. Trustee is a financial independent firm that acts as a bondholder's representative. Why corporate sell bonds? Bonds are often referred to as the workhorse of corporate finance and are sold to various reasons. Number one, finance a corporation ongoing business activities when it is difficult to sell stock and improves the corporation financial leverage and reduce taxes the corporation must pay to federal and state governments. Corporate bonds are a form of debt financing. Interest payment on bonds are required and bond owners must be repaid on a future date. In the event of bankruptcy, bondholders have a claim to corporate asset prior to that of the stockholders. Bonds are referred to as a, okay, this is already done. Type of bond. Most corporate bonds are debentures. Debenture is a bond that is backed only by the interests of the issuing corporations. Mortgage bonds are corporate bonds secured by various assets of the issuing firm, most appealing to conservative investors. The rate usually lower than those of unsecured debenture. Convertible bond can be exchanged at the owner's option with a specific number of shares of corporation and common stock. This is what I've done in the past with the pre-IPO on the private placement. For a company looking for strategic investors. A real bond is junk bond, pay high interest but have also higher risk of default. Provision for prepayment. Most corporate bonds are callable. Though many corporations agree to call bonds for the first 5 to 10 years after issuance, the call features allow firm to call in or buy outstanding bonds from current bondholders before maturity date. Two methods used for collection to ensure that they have sufficient funds available to redeem a bond issue at maturity. Number one, establish a sinking fund, a fund to which annual or semi-annual deposits are made for the purpose of redeeming a bond issue. Number two, issue a serial bond. Bonds are single issue that mature on different dates. Why you will purchase the corporate bonds? Number one, interest income is normally received with every 6 months until the bond maturity, where the interest is calculated as follows. Amount of interest equal to the face value times the interest rate. The method used to pay bondholders interest depends on whether they own registered bond or registered coupon bonds. The registered bonds are registered in the owner's name by the issuing company, while registered coupon bonds are registered on the principal owner, not the interest. Basically, the investor purchases corporate bonds for the three reasons: interest income, possible increase in the value, and the repayment of at the maturity. Okay, that's number one. Number two here, possible increase value again. Price of corporate bond may fluctuate in terms of maturity date and changes in the overall interest rate being primary cause of the most price fluctuation. Price of bond may also be affected by financial conditions of issuing corporation, supply and demand, and upturn or downturn in the economy, political uncertainty, or the proximity of the bond's maturity date. When interests are increasing and decreasing, it is possible to approximate bond market current value using the following formula. Approximate market value equal to the dollar amount of annual interest divided by corporate interest rate. Here is the way of calculating the market value. Okay, assume you purchase 1,000 HENS bond, pay 5.2%, annual interest is $50 a year. Also assume that new corporate bond issue compare quality of paying 4.75%. The approximate market value will be like this. This is the formula given to you. 52 is coming from here. 5.2 times 1,000. Compared interest is 5.75. 52 divided by 4.75, you got 1094.74. This give you a Khmer bond were lower than 52% for that of HENS bond. Excuse me. Number three is repayment at maturity. After purchasing bond, you have two options: keep the bond until maturity and then redeem it, sell the bond to another investors, value of your bond is closely tied to the corporation's ability to pay interest until maturity and repay its bond indebtedness at the maturity. Typical bond transaction: most bonds are sold through full-service brokerage firms, discount brokerage firm, or the internet. If you use a full-service brokerage firm, your account executives will provide both information and advice about the bond investment. The chief advantage using discount brokerage firm or trading online is lower commissions. Remember, you must do your own research with regard to the commission in terms of transaction costs. The actual amount you pay is often hard to determine. Ask the firm or account executive for the exact amount of what is being charged. Decision to buy or sell a bond. Okay, objective number 6. The internet may be used for various purposes when investing in bonds. Accessing corporations' webpage, obtaining price information of specific bond issued to track the value of your investments, and then trading one online and accessing specific bond website to get research about the corporation and government entity or its bond issue. In bond quotation, prices are given as percentage of the face value, 1,000. To find the actual current price of a bond, you must multiply the face value by the bond quotation. Here is an example of the bond prices. Quote 4% Walmart bond when matures 2008 is 117. The calculated current price of a Walmart bond multiply the face value by 1,000. So the face value is 1,000 times bond price quotation 117. So you got 1170. Yeah. Excuse me. In this case, Walmart's bond price is above 1,000 face value because Walmart is paying bondholders at 4% at the time when the current bonds are paying at less interest. Remember, when interest rate in the economy go down, the fixed interest rate will increase in value. So it has an inverse relationship. Remember that, guys. Okay. Bond rating. Detailed information about the quality and risk of a bond in terms of issue, bond rating, provision for payment, maturity date, interest rate, call provision, trustee, and detail about security provided by the Moody's, Standard & Poor's, as well as Fitch ratings. Again, here the example, the Visa corporate bond in the regulatory FINRA website. Price 105, coupon is 2.75, maturity date 2027, lookup symbol, this is the number, the yield is 2.62, rating is AA minus, coupon payment semi-annual, first coupon date is 2018, the typical corporate damager is 10 is callable. This is the industry sources there. The information is given to you in the FINRA website, gives you an idea of the detail. Percentage, number 1 is 1050 because 1,105. Coupon, 2.75. Maturity is 2037. Okay, because the bondholder will receive payment to the face value until 2037. The lookup symbol represent the value that you can need to do research when you look up in the Google or in the Google as well as in the internet sites. Okay, the number 5, number yield is 2.37.50 divided by 1050 equal to 2.62. Standard Poor and S&P, which is AA minus investment grade bond. Number 7, frequency of the tell the bond. Okay. Number 8, first coupon, which is 2018. The type indicated corporate bond, a debenture, which is callable yes. Okay. Yield to calculations, which is current yield, which is annual interest amount divided by current price. Current yield is determined by diving an annual interest rate amount by the bond current price. The higher the current yield is the better. Yield is the rate of return earned by investors who hold an investment for a stated period of time, usually 12-month period. Changes in the yield for a bond are caused by increase or decrease in the current price of a bond. Yeah, he gives you an example current yield, okay? Corporate bonds pay 3.25%. The face value is 1,000. It will receive 32.5. Where do you get this number? 1,000 times 3.25, you get 32.5. The current price is 1,058. So 32.5 divided 1,058, you got 3.07%. Okay. Let me get water. So I have a little bit sore throat here today. Other source of information, investor can use two additional sources of information to evaluate the potential bond investment. Business and Personal Finance Magazine, federal agency, as well as state and local governments. All right, so let's do a chapter summary here. Explain why you should establish an investment program in detail. Give you all these reasons. Number 2, Describe how safety and risk income and growth and liquidity affect your investment program. Remember, all investors must consider the factor of safety, risk, income, growth, and liquidity. It is important to know the relationship between safety and risk. Okay. Number 4, understand why investors purchase a government bond. Generally, they purchase government such as treasury bill, notes, bond, and treasury inflation, as well as protect tax security because most investors consider them as to be safe harbor at current economic times. Number 5, recognize why investors purchase a corporate bonds. Bonds are issued by corporate to raise capital. Corporate bonds may be such as debenture, mortgage bond, convertible bond, or high yield bonds. Investors purchase corporate bonds for 3 reasons: interest income, possible increase in value, repayment, or maturity. Most corporate bonds are bought and sold through full service brokerage firm or discount brokerage firm or the internet. You can buy it through using TD, example TD Investor Line or any Edward Jones and any other investment firm. Number 6, evaluate the bonds when making investment. Remember, you always check the quality using Moody's, Standard & Poor's, and Fitch rating. This is what I used in the past, so that's your benchmark. Okay, so that's basically the end of this chapter. Thank you, everyone. I'll post it in YouTube as well as Edpuzzle for your interactive learning. Thank you.